Hey everyone, today on the show, I have Mandy McAllister, who, unlike most of the people you hear on the show, is just buying deals for herself. She's not syndicating. She's not doing these crazy value adds. She's buying deals that she can figure out how to tweak and make money and doing it all herself. And so she's living the dream, owning the property without splitting the profits with a million other people. I'm really happy to have Mandy on the show. Mandy, welcome.
Hi, excited to be here. Thank you, Jonathan.
So for people who don't know you, 30-second intro, who are you and what do you do?
Sure. Mandy McAllister. I call myself a small multis investor. I buy 4 to 50 units with as few partners as possible. In the last year, I've had the opportunity to also serve as CEO of GoBundance Women, a tribe of healthy, wealthy, generous women who choose to lead epic lives.
Awesome. So you've got a lot on your plate, clearly. How did you get into this? I mean, tell me about how you sort of stumbled into the multifamily investing space in the first place.
I got interested in real estate investing in college at 19 when a friend told me her dad bought the house and she was renting out the rooms, and I realized you get to keep that money. That's the best idea I've ever heard. So it hit my brain that I needed to do this at 19. Finally, at the age of 35, 36, I found a fourplex in a college town. And immediately my first deal that I bought with express purpose of investment happened to have 4 doors. So it hit me like a ton of bricks that, wow, automatic scale can happen. It wasn't a tremendous amount of additional work to take down those additional doors. So let's add a 0. So I got bit early by accident, I guess.
But why did it take you 16 years between the time that the bug bit you and the time you did it?
Solid question, Jonathan, because I'm a perfect little girl who does all the right things perfectly. And I think that, I have this chance to lead GoBundance Women. I do see that the need to be perfect and get 100% right and be a straight A student thing, for women who are high achievers, they're not willing to take chances in the same way that men are willing to take chances. So figuring out my own brain and how to kind of hack myself around that it's okay to take a chance and fail. It took me 16 years to figure that out.
What were you doing? What was your career?
So I ended up doing a master's in economics, started on the floor of the Board of Trade, and then realized that was going away. So then I transitioned into medical device sales because chemistry was my first major in undergrad. So the bulk of my career was medical device sales.
And so you used money from that career to buy your first property, I take it.
Exactly. Yep.
And then so just tell me how it went from there. So you bought one, you're like, well, I got 4 doors. This is great, leverage, whatever. At that point, was it just a process of you kind of like saving up to buy the next one and saving up to buy the next one? Or just sort of describe what happened next?
Sure. So, I mean, when I didn't die after buying the fourplex and I had $1,000 coming in a month cash flow it was a $120,000 purchase. Why I thought I was looking back, why I thought I was going to die buying a $120,000 thing just feels ridiculous now. But I realized that, this was a path of a chance to gain more cash flow by positioning things in their highest and best way, right? So what I did is I bought a vacant, non-furnished fourplex, and I repositioned it as a student rental. So when you buy the couch and the bed, previously it was only getting $400 a month for a 1-bedroom, but when you buy the couch and the bed, you're going to get $800 a month for a rental and plug it into a group that's what they do. They manage student rentals. So once I realized that huge change in cash flow into my pocket, I wanted to recreate it. So I figured out how to cross collateralize a couple of things, use equity from different, like I had a condo that I was renting out that had a ton of equity in it from my days living in the city of Chicago, repositioned that equity into a 6-plex, and then just saved my way to a couple more transactions. That is the one big downside of buying your own stuff versus syndicating, because you're strapped to whatever you can bring in to take the next one down.
Did you at some point reach a point where the properties themselves were able to finance the next purchase, like where you no longer were doing it out of like how much you could save from your job, but you're starting to like pyramid up or leverage up on the properties themselves?
It takes a while. It really does, because $1,000 a month is $12,000 a year. If you're trying to buy $1 million property, it's gonna be a lot of years before you can have that down payment in order to make that happen. But when things appreciate, the chance to tap into the equity that exists. And then once you realize the magic of value add, and especially if you can do a value add that doesn't have a construction risk. This is my favorite baby, Jonathan. I love that. I preach this from the towers that, you know, if you have to do the type of a lift, if you have to completely rehab a unit to maybe hopefully get $400 more, $200 more in rent, then that there's a lot of risk involved in that. But if you buy something that is beautiful, but they're not charging a pet rent, or is beautiful and they're not charging a ratio rubs or parking, those types of value add that aren't construction risk are the things that really give me fuel that I run after.
Yeah, so I mean, I love this model, and I mentioned to you before we started recording that, you know, this for me was always the holy grail, even though, and it's kind of where I started, right? Looking for properties that were really more mismanaged than properties that were like needed to be gut renovated, you know, to turn into something better, right? And I always like this model because there's just a lot less risk involved than with all that construction risk, right? So I'd love to hear about how you, like, what is your, not the thought process, but I'm sure you have like a checklist or a way of identifying these deals that fit your model. You know, what does that look like? How do you find these deals and how do you evaluate them as being something that will work for this model?
I think another beauty of the type of investing that I do is that you don't need 10 deals a year. You don't need 4 deals a year. If I do a deal, a singular deal a year, then my net worth climbs, my cash flow every year climbs because I'm keeping 100% of it. I call myself an equity pod. So one thing when I have an opportunity to serve as mentor to people who want to invest in real estate is I encourage them to get really like blinders on in terms of a market. Because when I very first started looking into the 50-ish unit size, I knew I wanted to be somewhere that had a ton of population growth, a ton of GDP growth, a ton of job growth that I didn't see in the Chicagoland area, and, you know, let alone the landlord friendliness that we do not have in the state of Illinois. Well, that meant Indianapolis or Kansas City met my criteria so that I could get there and be back by dinner if I needed to go visit these properties. Well, because now I have put my blinders on and gone all in on Indy, I know the areas that make sense. I know that that rent will work here, but not inside the perimeter of those highways. You know what I mean? So really becoming an absolute expert on one place and not FOMOing your way to inaction has made it so that I can pull the trigger faster.
And then, so, and then tell me what it is that you're looking for in terms of like
Yeah.
the type of property or the, like the profile of the property
I
itself.
see. Yep. So I love a Class B asset. I mean, in terms of there not as much maintenance. I've done twice now buying from a developer or a redeveloper, because most times developers want to lease up so that they have warm bodies in there so that they can help you get your permanent debt, your agency debt, and then they want out, but they have not pushed rents to the top of where they could be managed, right? So if you can acquire something from a developer that has those bodies in it with a couple $100 of upside simply because they haven't managed it to the top, that is an ideal place for me. You don't see a lot of Class B stuff being developed, but that is my favorite asset class.
Yeah, I mean, and that's what, so when I started out, right, I bought a couple of deals from the same rehabber, and I love this model because I mean, I didn't know this going in, but I discovered it as I went, that their objective was very different from my objective. And their objective was, we want to get this place leased up as quickly as we can so that we can sell it and move on to do the next one, because their model was velocity of cash. They just wanted to keep on buying, rehabbing, selling, right? And so, but for someone like me coming behind them and buying, well, it was great because the rents were routinely below market, right? Because they just, they were turning a whole, 100, 200 unit property in 12 months, right? Re-tenanting the whole thing. So they just wanted speed, and they would not necessarily have the highest rents because they just wanted bodies in there. I could come behind them and like, hey, look, there's all this value left here. Unfortunately, what then happened was, when the market got crazy, all these deals started to sell. It was like, oh, we did 20% of the units, we proved the value add, now you go do it.
Right.
And it's like, that's not what I want. I want you to do it. And I want to go and just raise the rents afterwards, and that model didn't work much anymore. But maybe on smaller properties, you still can find that, or if you're buying it from the guy who built it, if it's a smaller deal, you've got that,
It's another beauty of this looking at smaller deals, because there's less competition, right? The institutional money isn't looking necessarily for a 20 to 50 unit property, right? And then the moms and pops, that's too big for them, right? So this is kind of this beautiful in between area that nobody's really looking. I do think that, I love that I don't have to do a deal, right? So because I chose to not syndicate, because I chose to kind of structure my life, that I have this floor of cash flow coming in from my assets, I'm able to live my life how I want to live my life. And then if I see a deal worth doing, then I pay it attention. I think the whole reason we chase financial freedom is for a chance to have control of our time. Well, I left a really big deal sales job, and I didn't want to sign up for another really big deal sales job to hundreds and hundreds of passive investors. Like I put the end in mind first so that I could live the life I wanted to live.
Yeah, I mean, you're just speaking my language, right? Because I think a lot of us, so especially people who got into the business, a decade or so ago, right? I didn't get into the business to give myself another job, right? I had a high pressure job as a Wall Street lawyer that I burned out on, and I didn't want to do that again, right? I wanted to go. One of the things that attracted me to real estate was the idea that you're going to do a bunch of work up front to get the deal done, but then the amount of hours you had to spend on any particular deal then dropped dramatically, right? And you can scale this and have a nice lifestyle. Then it got harder and harder to do that. The way that the market changed, you had to start bringing in lots of investors, and investors want their money back in 3 to 5 years, and it's just a churn. But the model that you're outlining, where you're doing it yourself, or you're doing it with just a couple of partners who are on the same page with you in terms of your game plan for the property, allows you to have a much better lifestyle. And you did mention before we started recording that you're in this for the long haul. You're not turning this around in 3 years. Like, you're holding these properties for presumably, till you right, forever, right? So
future. I have Fannie debt on most of my stuff for 12-year loans. Like, the longest term I could get, the better, because I want to hold these for cash flow to support my lifestyle. And it just so happens that as I hold them, I'm able to increase rents and increase that cash flow and increase the value of those properties. I love a Fannie loan because that allows me the flexibility to put on another loan product at some point in time and potentially pull out some of those proceeds if it makes sense. But again, I don't have to do a deal unless those deals are apparent to me and I want to go do a deal.
And in terms of buying, so if you're buying, say B property that's already been rehabbed by somebody else, right? To my mind, that then gives you a pretty long runway before you have to rehab again, right? And I mean, at some point you obviously do, or there's damage and things, or things eventually will get out of style, or just be too beat up. Have you had properties long enough that you've had to then go and start doing some rehab yourself? And if so, how do you do that? How do you finance it? Just tell me about that piece of the business.
Well, we have a CapEx reserves that we hold for every single month of collections, right? We are currently only 4 years in to the first time I bought something larger in this model. So we have not had the need. We've needed to do some refresh because some of the painting fades and the exterior stuff that we've done, but nothing has been really serious. The first couple transactions that I did were, just me, and like the 6th unit was a 1920s build. That has been, basically just pouring a lot of the cash flow back into it. But, again, this is why B class assets have my attention now, because I'm trading up. So, it's out of reserves is how I'm funding those things.
And so that 1920s property, what have been the issues that you've run into with that? Is it just systems failing because it's old, or like what do you?
It's on a boiler, and I mean that boiler, especially when energy prices spike, that's been a real pain in the nose. And just there's quirky stuff about 1920s builds, and the beauty of it though, and get it, it's a sixplex. Like this is something that like is not worth the brain space for most people, but I have it on a 4% loan, and it's right next to a hospital, so I get to midterm rent some of the units out. That's been really beautiful, because if your loan allows for you to midterm rent or short-term rent stuff, like I have this set up so that it's not extra brain damage to me. Someone checks in for 3 months or 6 months, and instead of an $800 rent on a 1-bedroom apartment that I get out of the rest of them, I get like $2,400, right? So a thing that I've been asking myself a lot during this irrational exuberance, huge tick up in interest rate, it's not how do I go acquire the next property, it's how do I do more with what I've got. And this midterm rental strategy, where my loan allows for it, where it makes sense in terms of geography, has been super successful for me.
And you mentioned a few other things that you do to add value without construction before we started recording. Talk about those as well. What are the other things that you like to do when you take over a property?
I love a pet rent. So not just the pet deposit. If your dog is going to live with you, you owe an extra $20 a month or something like that. That goes straight to your NOI, right? I love parking. I love asking for people to pay for parking, or at least a second parking spot. In that 6-unit building, I have storage lockers. If you would like to rent one of those storage lockers, I would love to rent it to you for an additional $30 a month, right? Those are my favorite, along with, a ratio utility bill back system, a RUBS. So if I'm underwriting a property now, I love to see when water is being paid for by the landlord, so that I know that I could capture that as additional revenue if I were to acquire it. So those are really my favorites.
And so the parking is, I'm presuming, sort of like they get reserved parking, they get a reserved parking spot that they own essentially as part of their apartment.
Yep, we just number the spots that are paid for. In one of our properties, we just charge for the second car, that your rent includes 1 car, but if you're going to have a second spot, we're going to charge you a $50 rent on that.
And then how do you manage these properties?
It's all third party. My favorite hack on this is, if you talk to a multifamily investor, they'll tell you only buy 100 units or more, because then you can afford to hire someone to be full-time on your property. And that is absolutely true. It's absolutely true that it's easier if you have one person's eyes on your property at all times. However, a thing I've learned is if you are partnering with a third party and you have a 50-ish unit, you need 50% of that person's time. So what you can usually barter is that you have that person on site Monday, Wednesday, Friday, or Tuesday, Thursday. And I've seen a lot of success in knowing that, Jennifer is going to be back in 48 hours, right? Sometimes it takes 48 hours to solve the problem instead of 24 hours, because that's how long it's going to take her to get back. But end of the day, the same person's eyes being on that property is the thing that allows for that beauty of continuity of management.
And how's that negotiated exactly? Like, so you're talking about negotiating with your management company to split somebody's time between your property and another property that's sort of similar size. Is that the idea?
Exactly. Yeah. We would like to have one person in charge of this property. And we understand we're only 53 units. So what would be appropriate to have her on site? Could we ask her to be on site Tuesday, Thursday? Could we ask for Monday, Wednesday, Friday? It's a conversation as acquisition is happening in interviews of third-party property managers.
And for a property that size, what are you paying in management fees?
It's about 8-ish%, but that bakes in the payroll as well.
So your employees' payroll is included in that 8%.
Exactly.
Okay, so that's not too bad.
Mm-hmm.
And then once one of the things that I did with smaller properties was try to locate them near something that we already owned. So buy like a bolt-on, and then we could share the staff between them. It sounds like with your model, are you doing something similar? Because since you talked earlier about how you focus on sort of one neighborhood or one market, are you able to then, just have like your management company be like, okay, well, we've got one person and she's going to all our properties. I mean, is that something else that you do?
That's the next right step in
Yeah.
what we're doing, right? I have not found anything in that area worth acquiring in the last year, let's say. I did buy something else in Indiana recently in the last year, but nothing in the Indianapolis space, because I can't make it work in terms of what I need to see for returns and what potential upside is there. So yes, once deals start loosening up, and when the stalemate that's happening between buyers and sellers right now slows down, that will be my next right step.
I'm curious, are you investing in anything else now, or are you just sort of building up cash, waiting for the market to free up so you can just buy more real estate?
That's a great question. So actually, a thing that has had my curiosity for some time that I'm dipping a toe in right now is that and here's my thought process on that. If I'm willing to buy a multifamily real estate asset at a 4 cap, what I'm really saying is that I'm willing to pay $25 for $1 of cash flow, right? If I'm buying at a 5 cap, I'm willing to pay $20 for $1 of cash flow. If I want to buy like a car wash, it's going to cost me $2 for that $1 of cash flow, or a laundromat, or something without a ton of employees that is a very real estate heavy play, but has more of a business aspect to it. Well, I'm currently under contract to buy a car wash, then I'm going to pay $2 for $1 of cash flow, with the intent of that being kind of an engine for cash flow, that at the end of the day, I'll be able to take those dollars and make them a down payment to something in one of these mid-sized multifamily.
I mean, so I'm very interested in this because I literally, in the last week or 10 days, so somebody posted on LinkedIn, I've got a car wash for sale in Brooklyn where I live. And I was like, okay, I'm curious about this. So I asked the guy to send me the information. Turned out to be the place I get my car washed, right? So I was kind of got myself excited. I dug in, not really a deal for me, but I'm very interested now in this car wash space. So I'm curious, sort of walk us through that, because I don't think people who are listening to this podcast they probably noticed that a lot of multifamily people are now dipping their toe into this space because of the way the multifamily market is, but they probably haven't really heard anybody, in your position who's really kind of gone through a deal with it. So walk us through this. How do you evaluate it? And
Yeah, well, I'm the type of investor, Jonathan, who likes to walk before she runs, which is also not a traditionally multifamily idea. You're supposed to go get the 400 unit first, right? Well, so this is, it's 5 bays. It's a 5-bay self-service car wash, which are less expensive than the automatic, right? It's 15 minutes from where I live because I want to be able to get my hands dirty on it. I bought a few years ago, because I couldn't stop myself, a single family home for $45,000, put 30 into it, and now I'm selling for 190. So that, what is it, 120-ish thousand, rather than pay taxes on it, I'm going to 1031 it into the building portion of this car wash. So I'm taking the car wash, I'm putting it into 2 different transactions, one for the business, one for the building, to afford a proper 1031 exchange. Well, in terms of underwriting a deal, as a business type deal, it's all on multiples of EBITDA, earnings before interest, taxes, depression, and amortization, right? So it's really that is the thing you're multiplying rather than your NOI. Like, think of that like your cash flow. So generally speaking, business brokers would be able to tell you, in the same way you would ask a broker of multifamily, what are Class B 50-ish unit properties trading for today? What cap rate is the prevailing cap rate in this market? You would be able to ask a business broker, what is the multiple of EBITDA that you see assets like this changing hands at, right? And for car washes, it's largely the 3x piece. One thing I'll tell you is mom and pop, these can be largely cash-based businesses. So a thing to be very aware of is whatever the tax return is, that's what you're going to be able to get the loan off of. So your negotiation of that business should be off of what their tax return says, not the inflated what they are trying to sell you comes in terms of cash, right? So that is the approach that I took to reach a price for this car wash.
And that was successful. you're able
was.
to, yeah.
Yeah.
And then what kind of loan, is this like an SBA loan that you get for this then, or is it, you're not getting traditional sort of real estate loan, I take it, on something like
Well,
this?
I am. So basically, open kimono. It's a $475,000 transaction. It's a walk before I run, right? Like I like to do the layup first. So I partitioned it off in $400,000 for the real estate that, is appraised, the appraisal value for the county that it's in Illinois is 570,000. So well within the range of what it should be worth. And then $75,000 for the business. I'm going to pay cash for the business. I could get an SBA loan on it, but I might go back in the future to put an SBA loan on the business portion of it. But it is a straight real estate deal when it comes to that $400,000. So the 100-ish and whatever from the 1031 is going to be the down payment. And then I'm going to be able to get a traditional 70-ish, 75% loan to value on the balance.
And just based on the cash flow coming off of the business, which is paying the rent essentially now to your, so you're basically doing like triple net lease on the land to the business to yourself.
Yeah.
And then there must be also a lot of like great depreciation here, right? Because you've got a lot of rapid depreciation kind of pieces to this business, right?
It's the same, 80% bucket that you would get in any sort of cost seg bonus depreciation for this calendar year. So I have a need for depreciation. So this is going to help that in a lot of different ways.
And then what about managing something like this? I mean, how many employees do you need? And, what does it look like as a business and in terms of your time?
Yeah, so that's the wild card. That is why I want to walk before I run. I can tell you what they currently have and I can tell you my plan, but I have no friggin' clue if it's going to work, right? So they currently, the owner works 3 days a week and then their handyman works 4 days a week. Our intent is to have someone on site 4 days a week. And we have a retired guy who's super handy. That it's our intent to have him doing the maintenance as we go. One thing that I've heard, one thing that I did in doing this is part of GoBundance. There are a lot of people who own car washes because we're largely investors seeking freedom of all kinds. And we, time after time, they say, well, you got to be handy. You got to make sure you have somebody handy on staff. So that is the primary takeaway that I've got, that we need more. I'm probably going to have to hire another handyman who's going to be able to fix hoses and call the right people when things break. So that's the plan as I see it right now.
But so this is essentially like you can run this with one employee on site most of the time because it's a self-service.
That's the type of business I was targeting. So a laundromat, one person on a part-time basis that could be in there servicing things, right? Same with a car wash. So the only type of business that I really have an interest in are the ones where it's, plugging it into my accountant, plugging it into my legal team, plugging it into the things that already exist for real estate, and then finding one operational person part-time to be able to take on the heavy lift. So again, caveat, I don't know if it's going to work exactly the way it is in my mind's eye because we have not closed on it yet, but that is the intent and what I've learned from other people who do this type of stuff.
Yeah, one of the things that sort of turned me off at the particular car wash that I looked at was I just from getting my car washed there, I knew that they had a lot of people working there, and I was concerned that most likely most of them were not legal, right? So and I was like, I was talking with someone I was going to bring in on the deal with me, and we were like, we don't really want ICE like knocking on our door in the middle of the night, one night. So, but the idea of going, then we started saying, well, hey, why don't we look for these self-service ones or automated ones where we have one employee, we can certainly make sure that the one person we hire is properly documented. And then we just don't have this issue, other issues probably, but we won't have that one in particular, and if this car wash, their whole business, the whole value proposition is this NOI, which is based on like underemploying or underpaying a bunch of like illegal aliens, like that's not exactly a business that I want to get into. So
it's not who I want to be either,
Yeah. So we got a couple minutes left. Tell me about GoBundance. So you said you're the CEO of the women's side of GoBundance. I don't know what you call it, but I guess that's the description.
Yeah, exactly. GoBundance Women, the spinoff that serves women that started in roughly 2019. As of about last year, so 11-ish months ago. They've spun it off such that it's for women by women, and I have the opportunity to serve as the leader. So we are largely real estate investors, because if you believe this idea that 90% of all millionaires are so because of real estate, you can anticipate the tribe of millionaires to be largely real estate investor. But we are many different asset classes under that umbrella. We really culturally take looks at our lives and take stock of what's important. Like, are you going on as much adventure as you wish you were? Are your relationships as connected as you wish they were? Are you giving back in a way that feels meaningful? So asking each other on a quarterly basis by way of a form we fill out helps us really stay on task. And it was interesting, actually, this morning, I think you know my friend Vanessa Peters, she's part of my pod that's in GoBundance. And I got a chance to go through the stock that I had taken in my own life. And I realized that over the course of the last 3 years since I've been doing this, like, I used to have no adventure at all. And then I bought an RV, and now I go on trips with my kids, and these are these memories that we love, right? And I used to pay no attention to my body, because like I grew up as an athlete. I played volleyball through college, and it was never a thing I had to think about. But well, I'm 42 now, so I gotta probably, it's the reason that I'm paying attention to parts of my life that I wouldn't otherwise is because of this exercise that we do. And I really believe most people spend more time planning Thanksgiving dinner than they do planning their entire dang life, right? So a chance to be part of an organization that culturalizes that look matters to me a lot.
And how did it come to be that you are the leader of this organization?
So buying multifamily, Jonathan, I had this floor of income. So I had this big goal when I joined as a member that I want to be able to be in control of my time. I want to be the mom that gets to serve at my kids as room mom for these parties. And I had all this space in my life that perfectly coincided with the chance for it to be for women by women. So they asked me to take over leadership, and it's been a really cool ride to get to make the tweaks that make it feel so much more special firsthand.
And how big is GoBundance Women at this point? How many members do you have?
We started right at the end of 2019, right at the beginning of 2020, just as COVID was a thing.
Yeah.
We are right now 140 members. The men's site started in the late 90s. There were about 1,000 members.
I have a number of friends who are members at the men's side of GoBundance. And what, for anybody who's like listening now and they're curious about if they can qualify for GoBundance Women, look, what are the membership requirements for it?
Yeah, so a net worth of $1 million or more, and if you're married, that can be combined, or an earnings of your personal earnings of $250,000 or more per year. The reason being, because if your net worth is $50,000, your set of problems to grow that net worth are different than if your net worth is $1 million. So we can serve you best if you're $1 million or more. We do, however, have a group that that's under the same parent company umbrella called Emerge that helps people with a net worth that's less than that.
Sort of like an accelerator program for
Exactly.
people who are,
yeah,
exactly. And I mean, we're almost out of time here, but I think this is a good place to sort of wrap up. Like, if people want to get in touch with you, because obviously you're not syndicating deals, so nobody's going to get in touch with you to invest with you. You don't even want them to contact you. But if they're interested in GoBundance Women, and they want to learn more.
Well, if GoBundance is interesting to you, or I do mentor people on buying their own deals, small multis.
Perfect.
MandyMcAllister.com is my website. I also have a freebie on my website to help you really define what financial freedom is to you, to put math to the problem, because the more truth you put to any problem, the easier it is to solve. So if you want financial freedom, do the math on what that looks like. What is your floor of income? There's a freebie on my website to download that calculator.
And give them the URL again for that.
Yep, MandyMcAllister.com. That's MandyMcAllister.com.
So by all means, everybody, please go to MandyMcAllister.com. Please get that free download. It sounds like a great tool. Mandy, this has been really fun. I really had a chance. I've really enjoyed this conversation a lot, and would love to have you back again. So let's do it again.
Yes, I'll tell you all about the car wash, and if it's meeting my expectations.
Yes, that'll be version 2, or part 2 of our of our podcast. So let me know when you close on that, and I would love to talk about that again.
You got it. Perfect. Thank you, Jonathan.
Thank you.